In the world of accounting, the concepts of bad debt expense and allowance for doubtful accounts are central to presenting a true and fair view of a company's financial health. These terms, though related, serve distinct but interconnected purposes in the accrual accounting framework. Their proper application ensures that revenues and expenses are matched in the period in which they are earned or incurred, rather than when cash actually changes hands. This matching principle is crucial for the integrity of financial statements, enabling stakeholders to make informed decisions based on realistic expectations about the collectability of receivables. Bad debt expense represents the estimated cost of uncollectible accounts receivable during a specific period. In other words, it is the portion of credit sales that a company does not expect to collect from its customers. The necessity for this estimate arises from the inherent risk that not all customers will fulfill their payment obligations. Especially in businesses that extend credit as a routine part of their operations, some level of default is almost inevitable. Recognizing this expense in the same period as the related revenue ensures compliance with the matching principle, preventing the overstatement of net income and assets. The process of estimating bad debt expense is not arbitrary. Rather, it is grounded in historical data, industry norms, and management's judgment. Companies may use several methods to estimate the amount of receivables that are unlikely to be collected. The two most common approaches are the percentage of sales method and the aging of accounts receivable method. The percentage of sales method applies a predetermined rate to total credit sales based on past experience and expectations of future defaults. This method is straightforward and aligns closely with the income statement, as it directly relates the expense to the period's sales activity. On the other hand, the aging of accounts receivable method offers a more granular approach. It involves categorizing outstanding receivables by the length of time they have been unpaid and applying different rates of uncollectability to each category. Older receivables are generally considered more likely to become uncollectible, so higher percentages are applied to these categories. This method provides a more accurate reflection of the collectability of existing receivables, making it especially useful for companies with significant and diverse customer bases. Regardless of the estimation method used, the recording of bad debt expense is accomplished through an adjusting journal entry at the end of the accounting period. This entry debits bad debt expense and credits the allowance for doubtful accounts, a contra-asset account that reduces the total accounts receivable balance on the balance sheet. The use of a contra-asset account is essential because it preserves the original amount of accounts receivable, providing transparency regarding gross and net realizable values. The allowance for doubtful accounts thus serves as a buffer, recognizing that some portion of receivables may never be collected. The allowance for doubtful accounts is not a static figure. It is adjusted periodically to reflect new information and changing circumstances. At the end of each accounting period, management reassesses the adequacy of the allowance, considering factors such as changes in economic conditions, shifts in customer base, and emerging trends in payment behavior. If actual write-offs of uncollectible accounts exceed previous estimates, the allowance may need to be increased through additional bad debt expense. Conversely, if collections are better than anticipated, the allowance may be reduced, resulting in a lower expense in subsequent periods. When a specific account is deemed uncollectible after reasonable collection efforts have failed, it is written off against the allowance for doubtful accounts. This write-off does not affect the income statement at the time it occurs, as the expense was already recognized when the allowance was established. Instead, the entry simply reduces both the accounts receivable and the allowance for doubtful accounts by the same amount, leaving net accounts receivable and net income unchanged. This treatment ensures that the impact of bad debts is reflected in the period when the related revenue was recognized, not when the write-off actually takes place. The distinction between the direct write-off method and the allowance method is critical in understanding the accounting treatment of bad debts. The direct write-off method, which recognizes bad debt expense only when a specific account is determined to be uncollectible, is not consistent with the accrual basis of accounting. This approach can distort financial statements by failing to match expenses with related revenues and by overstating assets until the write-off occurs. For this reason, generally accepted accounting principles, GAAP, require the use of the allowance method for most companies, particularly those with material amounts of credit sales. The implications of bad debt expense and the allowance for doubtful accounts extend beyond mere compliance with accounting standards. They play a vital role in risk management and financial planning. By systematically assessing the likelihood of collection, companies can better anticipate cash flow needs and make informed decisions about credit policies, customer relationships, and resource allocation, A well-managed allowance account also signals to investors and creditors that management is vigilant in monitoring credit risk and maintaining realistic expectations about asset recoverability. Moreover, the estimation of bad debt expense is not without its challenges. It requires a delicate balance between optimism and prudence. Overestimating bad debts can understate profits and mislead stakeholders about the company's earning potential, while underestimating them can inflate assets and net income, creating an overly rosy picture of financial health. Auditors and regulators pay close attention to the assumptions and methodologies used in estimating bad debt expense, as these can significantly influence reported results. In practice, the accuracy of bad debt estimates depends on the quality of underlying data and the rigor of the estimation process. Companies must maintain detailed records of credit sales, customer payment histories, and write-offs. Regular analysis of trends and patterns in receivables can help identify emerging risks and inform adjustments to the allowance. In industries subject to rapid change or economic volatility, management may need to revise estimates more frequently to stay aligned with current realities. Technological advancements have also transformed the way companies manage bad debt expense and allowance for doubtful accounts. Modern accounting systems can automate much of the estimation process, integrating real-time data and analytics to improve accuracy and responsiveness. Machine learning algorithms can analyze vast data sets to identify predictors of default, enabling more precise segmentation of customers and more tailored risk assessments. These innovations not only enhance the reliability of financial reporting, but also support proactive credit management strategies. From a financial statement perspective, the presentation of accounts receivable net of the allowance for doubtful accounts provides users with a realistic measure of the amounts expected to be collected. This net realizable value is crucial for assessing liquidity, evaluating working capital, and forecasting cash flows. Investors, lenders, and analysts rely on this information to gauge the quality of a company's receivables and the soundness of its credit practices. Large or unexpected increases in bad debt expense or the allowance account may signal deteriorating credit conditions or weaknesses in customer screening and collection processes. The interplay between bad debt expense and allowance for doubtful accounts also has tax implications. While the recognition of bad debt expense for financial reporting purposes is governed by accrual accounting principles, tax authorities often have different rules regarding the deductibility of bad debts. In some jurisdictions, only actual write-offs may be deductible for tax purposes, regardless of the allowance established for accounting purposes. This divergence can create temporary differences between book and taxable income, affecting deferred tax calculations and overall tax planning. Internationally, accounting standards such as International Financial Reporting Standards, IFRS, and US GAAP provide guidance on the recognition and measurement of bad debts and allowances. While the core principles are similar, there are differences in specific requirements and disclosures. For example, IFRS 9 introduced an expected credit loss model, requiring entities to recognize losses based on forward-looking information, even before a default event occurs. This approach aims to enhance the timeliness and relevance of loss recognition, particularly in the wake of financial crises that exposed weaknesses in traditional incurred loss models. Effective communication of policies and estimates related to bad debt expense and allowance for doubtful accounts is essential for transparency and stakeholder trust. Companies should disclose the basis for their estimates, the methods used, and any significant changes in assumptions or circumstances that could affect reported amounts. Clear and comprehensive disclosures enable users of financial statements to understand the judgments involved and to assess the reasonableness of reported figures. In addition to financial reporting considerations, managing bad debts and allowances has operational implications. Companies must strike a balance between extending credit to drive sales growth and minimizing exposure to uncollectible accounts. Robust credit evaluation procedures, ongoing monitoring of customer accounts, and timely follow-up on overdue balances are critical components of effective credit risk management. Collaboration between sales, finance, and collections teams can help identify at-risk accounts early and implement appropriate interventions to mitigate losses. The impact of economic cycles on bad debt expense and allowance for doubtful accounts cannot be overstated. During periods of economic expansion, businesses may experience lower default rates and reduced need for large allowances. Conversely, recessions and downturns typically lead to higher levels of customer insolvency and increased bad debt expense. Companies must remain agile in adjusting their estimates and policies to reflect changing economic conditions, ensuring that financial statements continue to provide a fair representation of risk and performance. Industry-specific factors also influence the estimation and management of bad debts. For example, companies in industries with high customer concentration or long payment cycles may face greater exposure to credit risk. Similarly, businesses operating in emerging markets or dealing with high-risk customer segments may need to adopt more conservative approaches to estimating bad debt expense and setting allowances. Benchmarking against industry peers and best practices can provide valuable insights into appropriate levels of allowances and effective credit management strategies. The role of external auditors in reviewing bad debt expense and allowance for doubtful accounts is to provide assurance that these estimates are reasonable and consistent with applicable accounting standards. Auditors evaluate the methods and assumptions used by management, test the accuracy of underlying data, and assess the adequacy of disclosures. They may also perform analytical procedures to identify unusual trends or inconsistencies that warrant further investigation. The auditor's opinion on the fairness of financial statements hinges, in part, on the credibility of these critical estimates. From a managerial perspective, the process of estimating and managing bad debt expense and allowance for doubtful accounts offers opportunities for continuous improvement. Regular review of credit policies, customer screening criteria, and collection practices can help reduce the incidence of bad debts and enhance overall financial performance. Training and incentivizing staff to prioritize collections and maintain strong customer relationships can also contribute to lower default rates and healthier receivables portfolios. Looking ahead, the increasing complexity of global business, the proliferation of digital transactions, and the evolving regulatory landscape will continue to shape the way companies approach bad debt expense and allowance for doubtful accounts. The integration of advanced analytics, artificial intelligence, and automation promises to further refine estimation processes and enhance the effectiveness of credit risk management. However, the fundamental principles of prudence, transparency, and sound judgment will remain central to the responsible management of receivables and the faithful representation of financial position and performance. In summary, bad debt expense and allowance for doubtful accounts are foundational elements of accrual accounting, ensuring that financial statements present a realistic view of a company's assets and profitability. Through careful estimation, diligent management, and transparent disclosure, companies can navigate the challenges of credit risk, safeguard their financial health, and maintain the confidence of stakeholders. As the business environment evolves, so too will the tools and techniques for managing bad debts. But the underlying objectives of accuracy, reliability, and integrity in financial reporting will endure.